Welcome everyone to our OakBridge Weekly Market Update. We had a pretty good market last week. The markets are up and sustained those. And again, the markets have closed a little bit higher today. We're grateful for those things when they happen. And we anticipate that we will still have a little bit more volatility before the end of the year. But we wanted to kind of jump in and talk about the political election process and how it impacts the markets, the economy, and those various types of things. One of the things that we talk about a little bit, and we kind of look at some of the charts that we have, is that the reality is that most Republicans feel like that the economy is doing better under a Republican president, and interestingly enough, most Democrats often feel better about the economy under a Democratic president. And as they've done surveys over the years, it's interesting to watch those, that it is kind of by election lines or party lines as far as how you feel about the economy. Interestingly, though, during Trump's administration, the Trump administration had a return of about 16%. And before him, his predecessor, President Obama, had a return in the market of 16.3%. So even with different presidents, different political environments, the markets still seem to find a way and still seem to be able to accomplish what they're supposed to accomplish. I've got a chart here that I'm just going to spend a brief minute on. What you can see here is this is the S&P average return since 1940. Based upon election year, presidential election year, non-election year, and then overall what the market's done. You can see in midterm elections has probably been the lowest of all of the average returns. Now, as we talk about this, these averages obviously don't take into account tech bubbles and the markets in 2008 and all of those types of things. These are just averages as over the last 40 or so year or 60 or so years that we've had in the marketplace. So midterm elections, however, have tended to do the least well during preceding the elections at a 5.4% return. Presidential elections actually have done a little better at a 6.4%, and then in non-election years, average return 11.9%. Overall, around 8.9%. But here, I think, is even the more important part of this. What you can see is that during a midterm election year, this is measuring volatility in the market, and it's measuring it by standard deviation. Basically, all this measures is how much above the average it goes and how much below the average it goes. So, for example, if the average market return, just to make math simple, was 10% and you had a 15% standard deviation or volatility index, that means that the average volatility during that time would be somewhere between 5% and 25%. And so, a negative 5% and a 25%. So those are kind of the ranges that we look at. And you can see that from a volatility standpoint, the midterm elections are the most volatile of any of these measured here. Presidential elections actually is a little less volatile. Non-election years is the least volatile at 12.9%. The end result is we see the markets kind of chugging away. We see them kind of parsing the information with regards to the interest rate increases that are happening, as far as the economic conditions, as far as the corporations where their profit margins are going to come in. And we anticipate a continued volatility through the end of the year. And it's just normal. It's just the way that the markets work during these times. Eventually, the market figures itself out and gives us the returns, hopefully, that we're looking for. And historically, in the past, it has always done that. So anyway, as we go forward, just a little thought process that a good investment strategy does not include hating the current political environment. So don't base your investment strategy based upon your hatred of the government, because it always will lose. Anyway, thank you for watching today, and we'll pick you up next week, and we'll do another one next week. We appreciate everyone that tunes in and listens to these. Thank you so much.